Hey guys, here we at the middle of July 2023. As someone who invests in China, I gotta see, things are looking up. The darkest days seem to be behind us. We are not only seeing the end of all the restrictions brought on by the pandemic, but we are also adapting to the various economic changes we've faced. And let me tell you, a lot of local investors have taken a beating. Some have even fallen into the depression. I know that might sound a little bit extreme and everyone's experience is different. But if you've been holding on to some Chinese financial assets over the past 3 years, you know what I'm talking about. Personally, I invested in both Chinese A-share stocks and overseas listed Chinese concept stocks. So I've got a pretty deep understanding of what's been going on. And today, I want to share with you some insights into the overall market change and some underlying trends. This is directional thing, guys. It's logic behind the things. So don't miss out today. Very important. Well, I'm a stock analyst based in China and I'm also trading stocks. My goal is giving the investors a different view to look at Chinese concept stocks. If you don't want to miss the quality stock analysis videos, don't forget to follow my channel and turn on the little bell. Now let's get into it. Firstly, let's talk about the recent resurgence of Chinese concept stocks. What's the fundamental reason behind it? Well, I will summarize a few points for you. First of all, it seems like all the bad news surrounding Chinese concept stocks is finally out in the open, which means that there's a lot of potential for them to rebound since their stock price are currently at a very low point. We talked about how Alibaba and Group was fined in my last video, and that was a pretty iconic moment, you know? It's like a summary of all the negative factors in the past has been cancelled. And when it comes to the future of the AI technology industry, internet companies are going to be leading the way. So the next wave of AI is going to be driven by these internet companies. And I'm telling you, it's going to be a massive entrepreneurship movement. And recently, we're seeing a lot of these Chinese concept stocks already top performers in their respective industries, which means that they're well positioned to benefit from the AI wave. Secondly, the Chinese current RMB is expected to appreciate, which will attract a lot of foreign investment into Hong Kong and stimulate the explosive growth in Chinese concept stocks. The RMB has already reached a high point, which means some investors might be scared off. But as long as the government continues to stabilize the exchange rate and attractive investment, we should see a massive influx of capital flow into the RMB, leading to another big appreciation trend like we saw in November of the last year. So be cautious about shorting the RMB and keep an eye on its appreciation potential. Of course, here we have to talk about the US Federal Reserve and whether or not they will raise interest rates. The latest data shows that the producer price index in June was lower than expected, which means the Fed might post their interest rate hikes. And from what we are seeing, it looks like the Fed's low interest rate hike policy is coming to an end. So there you have it, guys. These three factors are driving the recent surge in Chinese concept stocks. But the question is, will this surge last? The answer depends on the performance of the corresponding companies and the government's policy towards the platform economy. So keep an eye on those factors and invest wisely. Fortunately, we've got some positive signals coming our way right now. On July 12th, our Prime Minister Li Qiang is giving a shout out to the platform economy. He's saying it's opening up new demand, powering innovation, creating job opportunities, and supporting public services. He's urging these platform companies to keep their eyes on the prize, keep pushing that innovation, and really power up the real economy. In China, we call these platform companies big factories. In Chinese, it's 大厂, and a lot of fresh graduates, they're diving to get in the 大厂, making the big factories their top job choice. So it's no surprise that the Prime Minister is backing the platform economy. Makes total sense. We've also been hearing some upbeat chatter recently, feeling like the darkest time and fading. But what we are really looking forward to is the jewel of a new day. We're hoping to see some real, tangible improvement in the economic data. Speaking of the data, the National Bureau of Statistics jobbed some new members on July 17th. First half of this year, our GDP clocked in at 59.3 trillion yuan. That's a 5.5% year-on-year increase. The Bureau is saying that is the first half of the year, despite the tough international environment and the heavy domestic reform and development tasks, everyone's been focusing on stabilizing growth, employment, and prices. Market demand is gradually coming back. Production supplies on the up and up. The economy's overall performance, I think, is getting better. However, the stock market has no appetite on that. Do you know how this recent market reaction to China's economic recovery? On July 17th, the A-shares market dropped nearly 1%, which is a bit embarrassing. But why did this happen? Well, I think because China's second quarter GDP grew 6.3% year-on-year, which is higher than the first quarter's 4.5%, but still lower than 7.1% predicted by Bloomberg. This difference between expectations and reality is what's causing the market's reaction. So, how much has China's economy really recovered? I think most of you may be most concerned about this point. To answer that, I'm going to share some insights from the China's macroeconomic forum's midterm analysis and forecast of China's macroeconomy in 2023's report. First off, let's summarize the first half of the year. They give the following conclusion. The first conclusion is the three pressures of demand contraction, supply shock, and the weakened expectation have been alleviated to some extent, showing a bottoming out and a rebound trend. And second one is the recovery speed of demand side is slower than that of the supply side, as seen in the CPI's decline, PPI's expansion, and overall decline in the GDP deflator. The third one is macro hot, but micro cold, which is another prominent feature of China's economic operation in the first half of the year. After 3 years of pandemic control, China's economic recovery will go through three stages. The first stage, social order and transaction repair, then asset liability repair, and the third, normalization expansion. Next, we are currently at a critical period of transitioning from the first to second stage. However, there are still some challenges and pain points in the economic recovery, which can be summarized as 5-20%. The first 20% is youth unemployment rate surpassing 20%. Second, industrial enterprise profits falling by 20% year-on-year. The third, local land transfer income falling by 20% year-on-year. And the fourth one, real estate new construction area falling by 20% year-on-year. The last one, consumer confidence index gap reaching 20%. So there you have it, guys. China's economic recovery is still facing some challenges, but it's slowly transitioning to the next stage. Now, let's take a look at China's economic outlook for the second half of the year. Looking ahead, China's economy is expected to accelerate its recovery from the first half of the year, repair the micro foundations, improve market expectation, and move forwards expansionary growth. The favorable factors supporting China's expansionary growth include the convening of Chinese National Congress and adjustments in the pandemic prevention and control, which will initiate a new round of construction cycles. The midterm of 15th five-year plan will have greater investment driving effects. What's more, the improved efficiency of macro policies will play a more effective role in maintaining the stable growth. More importantly, China's low inflation level leaves more room for monetary policy, and the risk hedging effect of the asynchronization of China's and the world's economic cycles. However, throughout the recovery process, China's macroeconomy may face 6 short-term risk points. First one, insufficient macro policy strength or early withdrawal leading to the risk of interrupting the recovery progress in the second half of the year. The second one, the resonance between the real estate and automobile markets causing significant short-term downward pressure. The third one is increasing debt pressure of local governments and financing platforms causing structural and regional risks. And the fourth risk is continued pressure on Chinese exports due to the global economic slowdown. The fifth one is the turmoil in international financial markets, exacerbating fluctuations in China's capital markets. Last one, the risk of intense economic spillover effects due to the confrontation between international camps caused by the Russian and Ukraine conflict. Consumption is expected to be the main driving force of short-term economic growth. Looking at 3 major industries, the service industry is expected to grow by 7%, the secondary industry by 4.2%, and the primary industry by 3.5%. The service industry is expected to be the main driving force of short-term economic growth. Finally, I want to see that everything is cyclical. There's no permanent decline or permanent recovery. Everything has its ups and downs. So at this point of time, I advise you to give more patience to Chinese concept stocks. If you want to invest in China, subscribe my channel and get a latest perspective of the equity research.